optimizing capital in option trading. Let's see what the boys or the research team decided to take a look at this time. I haven't had a chance to review this one yet this morning, so it'll be fun. So in the world of financial trading, understanding the dynamics of delta values and their impact on investment strategies is paramount. Delta, a key metric in option trading, measures the sensitivity of an options price to changes in the underlying value. It's like, think of delta like number of shares. It's the easiest way to think of delta. It's just a theoretical share equivalent. So this study delves into the nuanced realm of delta dynamics to uncover optimal strategies that not only enhance returns, but also mitigate risk. One of the things about Tasty is we don't have any idea what's going to happen next. So we never tried to convince people that we have any idea what's going to happen next. What we tried to do is to research things and create a set of optimal mechanics so that if all things are equal, you have the best chance of success. So let's explore how delta influences capital allocation, returns on capital, P&L, and option risk. There's a lot of stuff in there. It's a pretty heavy study. So basically 19 years. We looked at 45-day expiration short options. Of course, we're going to manage at 21 days. We compared 16, 20, and 30 delta strangles, and we checked everything from buying power, percent of annual return on capital, historical performance. We looked at underlying price, and for each delta, we calculated the buying power, the annual return on buying power, and compared it to the overall performance. Would you like to take a pre-segment guess as to whether the 16, the 20, or the 30 delta strangle? And we've done a lot of studies on this that show that somewhere between 16 but probably 20 has always been regarded as kind of the optimal sweet spot. Take the least amount of risk, make the most amount of money at the 20 delta. Let's see if this study comes to a similar conclusion.
Thing.
Yeah.
Yep.
So first of all, we start off with the first table, which demonstrates how different deltas under strangle strategies influence the overall performance. It's clear that the delta has a positive correlation with P&L, risk, CVAR, and buying power and the annual return on capital. POP remains stable when the deltas change. So the first thing we notice here is that the P&Ls are pretty, nothing would blow you away one way or the other because they're right. They're right in line. This is all at 21 days. Mm-hmm. The historical POP, like we said earlier, is always going to be the same. The buying power is going to be pretty close to the same. The CVAR is going to be, there's a marginal difference. And the percent of annual return on capital is going to be pretty damn close. If you looked at all these things and you had to make a judgment, you'd probably go, okay, well, the thing that makes the most sense here is the 20 delta because it's got, middle range price, middle range POP, middle range BP, middle range CVAR, and middle range percent of annual return on capital. Okay, it makes the sense. It just logically makes sense across the board, the 20 delta.
Yes.
Let's go to the next slide. So the positive correlation of delta with P&L implies that as delta increases, options start behaving more like the underlying asset, which can lead to larger gains or losses. Risk, CVAR, indicates that options with higher delta values can lead to increased risk due to their higher sensitivity to price change. So an increase in delta means more significant profits when the underlying assets move favorably, making high delta options attractive for traders aiming for large annual returns. You want to give yourself a little directional bent if you're aiming for a large annual return. While the stable POP, this suggests that factors beyond delta, such as option strategy, position size, implied volatility, time to expiration, significantly influence the likelihood of achieving a a profitable outcome. None of this stuff is new. It's all just really good to hear it repeated because it's kind of a slightly different format. Let's go to the next slide. So this table illustrates how the buying power what they'll be if the underlying price increase within a span of $50 under different delta strategies. So one quick observation is the underlying price and the delta increase also increase the buying power increase. So, or also create the buying power, force the buying power to increase. So let's take a look here. So basically saying that when the price of the underlying goes up, you're going to have, it's more expensive to trade. That's all the slide shows.
Yep.
So if you're doing the 16 delta, if you're $250 to $300 stock, you're at $5,000 to carry a one lot. And if you're doing a $100, $150 stock, it's less than half that, $2,200. So you might want to look at stocks by price to give yourself, an idea of what you want to trade. Let's go to the next slide. The positive correlation between these factors highlights the importance of considering both asset price movements and option delta when assessing capital requirements in option trading. So when you look at your capital requirements, if the stock's too expensive, it may be a negative to your ability to allocate your portfolio to really expensive stocks. And what a lot of people do is they will use too much of their capital in too few underlyings. So I think what this is trying to point out is that if you spread the wealth around, like on the first slide, we showed how you spread things around. Then on the second slide, you also see how you can spread things around more effectively based on underlying price. So it underscores the importance of prudent capital allocation in option trading, particularly when dealing with assets of higher and greater market volatility. This approach involves managing capital wisely, taking into account both asset price fluctuations and option sensitivity to control risk. It's really good.
Very nice. Good job.
Really good piece. Because price does come into play. So as the delta values increase, the more options typically require more capital to reestablish and maintain because they have a larger impact on the overall portfolio risk. This is why there is a positive correlation between option buying power, between delta and option buying power. I'm sorry. This is why there's a positive correlation between delta and buying power requirements. That's what I meant to say.
Good.
Within the array of tested delta values, here it is. The 20 delta strangle stands out due to its superior performance. Okay, well, that's in line with everything that we've done in the past. It exhibits the highest percentage of annual return on capital with a significant P&L with well-managed risk when compared to others. Additionally, it boasts the highest risk-adjusted returns, averaging at 15.5%, surpassing others in that regard. And before you think that 15%, managing one strangle at 15% over the course of a year, over 18 years, is low, you have to remember, this is only taking about, this is when you have the high probability of success, and you're taking very low risk in this particular trade. Like if you're selling 16 delta strangles or 20 delta strangles, you're taking about 16% in risk to average just under 16% over the years. When you're taking, as far as trade risk, you're taking up to 3x the amount of risk. What is it? Because it's about 18,000. Yeah, you're taking about 3x the amount of risk for
less reward.
Yeah, for less reward. So, and this is all SPY. So if you figure, okay, SPY is trading for 15% implied volatility or 18% implied volatility today. If you went to some other underlying, let's just say you used Tesla or you used NVIDIA, whatever it is, because I got to put this in context. NVIDIA, which is one of the most actively traded stocks, has an IV rank of about 50. When you talk about 48 to 50, when you talk about option trading, I'm sorry, not IV rank. The implied volatility of NVIDIA is between 48 and 50. When you look at the implied volatility, let's just say it's 48. When you look at the implied volatility of the S&Ps, let's just say it's 16, right? What it was coming into today. So NVIDIA is going to be priced 3 times what the S&Ps are priced at, because it's just a multiple of. So if something is $1 in S&Ps where you're making your 15.6%, if you trade NVIDIA, it's going to be $3 and you're going to make 46%. That's why we think you can easily do better than that.
Very good, sir. Let's take a quick 90-second break and come back. We got more Tasty Live after this with Joy, Mr. Scott Sheridan, Tasty Trade World Headquarters next.